What's up, everybody? It's Rashad here, and this week we sadly got some very unfortunate news that the great investor Charlie Munger has officially passed away at 99 years old. He was actually 5 weeks away from turning 100, but while he was alive, he left the investing world with a ton of knowledge, and that includes myself. I've learned a ton of things from Charlie Munger over the years, and I just want to take a little bit of time to share some of the few things that I've learned from Charlie Munger during my investing journey. So there's been hundreds of articles written since yesterday. He actually officially passed away yesterday, November 27th. But if you don't know who Charlie Munger is, he's famous for being Warren Buffett's investing partner. They kind of refer to him as Warren Buffett's sidekick, as you can see here on this article. But he's not just the Robin to Warren's Batman. He's much bigger than that, and a lot of Warren's current investing strategy comes from Charlie. Charlie actually changed Warren's investing strategy. Warren Buffett learned investing from the late great Benjamin Graham, and the strategy that Benjamin Graham taught Warren Buffett was the cigarette butt strategy. And what that means is they would find companies that were kind of on their last breath, and because of that, they sold for really, really cheap. And so the cigarette analogy comes from being able to take a few last puffs from that cigarette that you maybe found on the floor for free, right? In this instance, he would find businesses that were doing pretty poorly and were selling for even cheaper than what they were worth and get a few more puffs out of it. Well, when Charlie came around, he kind of convinced Warren to, instead of finding fair companies at great prices, to now invest into great companies at fair prices. And that is the strategy that Warren still exercises until this day, and that has made him worth over $100 billion. So if we take a look here, this is Charlie Munger right here. Like I said, he was 99 years old. I never really remember a young Charlie. Okay, I'm 34 years old currently, and I've been investing for a little while, but he's kind of always looked like that since I've known him, at least. So if we scroll down here, Charlie Munger, who helped Warren Buffett build Berkshire Hathaway, has died at a California hospital. He was 99 years old. Berkshire Hathaway said in a statement that Munger's family told the company that he died Tuesday morning at the hospital just over a month before his 100th birthday. Then Berkshire Hathaway put out a statement that said Berkshire Hathaway could not have been built to its present status without Charlie's inspiration, wisdom, and participation, Buffett said. The famous investor also devoted part of his annual letter to Berkshire shareholders earlier this year to a tribute to Munger. Munger served as Buffett's sounding board on investment and business decisions and helped lead Berkshire for more than 5 decades and served as a longtime vice chairman. Now, if we scroll down here, you'll see it says, but Buffett always credited Munger with pushing him beyond his early value investing strategies to buy great businesses at good prices like See's Candy. So Berkshire owns several companies in whole, then they have several that are publicly traded that they own portions of as well. But See's Candy is one of the companies that it owns in whole, and I think that's actually Buffett's favorite purchase of all time. Okay, so they own companies like See's Candy. They also own Dairy Queen. I actually know all about this firsthand, as I used to own an ice cream parlor, actually a few ice cream parlors, and so Warren Buffett's company, Dairy Queen, was obviously one of my main competitors. Here's another quote: Charlie has taught me a lot about valuing businesses and about human nature, Buffett said in 2008. So this paragraph here kind of tells you about the investing strategies that I was discussing before. But Buffett's early successes were based on what he learned from former Columbia University professor Ben Graham. He would buy stocks in companies that were selling cheaply for less than their assets were worth, and then when the market price improved, he would sell the shares. So that initially worked very well for him. However, had he stuck with that, he wouldn't have received the returns that he received from huge companies like Apple and Coca-Cola. He's made several billions of dollars from those companies, and he also receives huge dividends from those companies as well. And if I recall, he owns so many shares of Coca-Cola that he actually receives more money from dividends from Coca-Cola stock than the CEO of Coca-Cola makes for the year. That's pretty crazy. But now I want to head over to this article here on CNBC, Diversification and Lifelong Learning, 3 quotes from Charlie Munger that will make you a better investor. So there's 3 quotes on here that I want to share with you, but the second one is the one that I like the most. So it says, a lot of people think that if they have 100 stocks, they're investing more professionally than they are if they have 4 or 5. I regard this as insanity. So the reason he said that is, you should always stick to your circle of competence when it comes to buying stocks. Now remember, buying stocks is like buying an actual company. Now you wouldn't go out into your city and buy, a storefront that you knew nothing about. You don't know how they make money. You don't know how they lose money. So you shouldn't do that when you are buying stocks in the stock market. If you happen to find 5 companies that you know very well, you've looked at their financials, they're doing well, you understand the ins and outs of the company, you like the leadership, they're selling for a good price, then oftentimes it is better to put more money into one of those 5 companies than it would be to go purchase other stocks that you don't fully understand and that are not in your circle of competence. And so he's kind of quoted here saying, I think it is much easier to find 5 than it is to find 100. By the way, I call it diversification, which I copy from somebody. And I'm way more comfortable owning 2 or 3 stocks, which I think I know something about and where I think I have an advantage. So if you're willing to put in the work and research companies and find out more about the companies and make an educated investing decision, then smaller may be better. However, if you're not willing to do that, then just purchasing an index fund or an ETF that holds the S&P 500 or the total stock market and just dollar cost averaging into that on a consistent basis is probably a better game plan for you. To Charlie, we appreciate all the lifelong lessons you've given us over several decades. Speaking for the investing world, we appreciate all the advice. I know I was made a better investor because of the lessons that you've taught us, and I'm sure there's several others that will say the exact same thing. Thank you for everything. Peace.